What's going on, everybody? Welcome to the show. I'm Susu. For those of you that don't know, if you've already seen the show, then thank you for showing up. Always a pleasure having you back. All right, Overstock.com. We got to look at this. Look at the 1 month chart here. It's been like that for the most part. But there's something I have noticed. If you go look at that 1 month chart, look at how many times it's broken out of the Bollinger Bands and then reacted downward. Now there's actually a little point on here I want you guys to focus on with me, and this may be the right time to sell, okay? I mean, this is just my opinion. Remember, you're allowed to do whatever you're gonna do, and I feel like you should, but I also feel like you should be trying to find some information within the chart that might be useful to you maximizing your profits if you're already in this. Now, let's take a look here. And this is one thing I wanted to show you. Looking at the Bollinger Bands, which I use in the Bollinger Bands, I use a deviation of 2 and a period of 20. Okay, it's actually the default setting. I always use it. I'll never change my mind. I don't care what anybody says. If you use your setting, but I don't want your setting. I want the one I have, and hopefully that doesn't make anybody mad. Now check this out. Here is the last time that the Bollinger Bands were crossed at the same time that it ran into a resistance line that was a moving average. It's right here, okay? Now this right here, if you look, that red line right there, that red line is actually your 50-day moving average. Now you have these red lines. That's your top of your Bollinger Band line. That's the middle, and this is the bottom. The other line, as you can see, is actually a deep red. It's this blood red line right here, and that's your 50-day SMA. You can see up there, if you actually look up there, you can see 50-day, your 20-day, and your 200-day. So go right there and follow that line right there, and there you go. That is right there where it went up and touched that. In addition to touching that, it also passed through its Bollinger Band right here, and that's the top of the Bollinger Band. See, because you have 1 line, 2 line, 3 line. This is the middle, that's the bottom, that's the top. When something passes through the top of the Bollinger Band, technically that is a sell signal. And if something falls out the bottom or touches the bottom, technically that is a buy signal. Now you can see where the touching the bottom worked great here. It would have told you to buy right here as it touched it or came near it. It could have been a buy. Obviously you want to see if it falls out of the bottom. If it falls out, that's far more reasonable to be a buy signal, because it fell out and that means it's oversold. And then boom, look at that rise you would have got out of that, boom. And then look, had you followed it right away, it was like boom, falling out the top, and then you would have been like boom, and then you would have came right here and you could have considered buying back, or you would have missed the next rise up. But the point is this: it did run into a moving average there, at the same time breaking through a Bollinger Band, and it was rejected down $2. Okay, now at the time 12 to almost 10. Actually, it was like 12:05 to like, that's not 10. That's more like 11. It was about a 10-15% reach, about 10%, I would say, closer to 10% drop, maybe a little more, maybe a little less. I can't see what the actual dollar amount is. That might be closer to like 1080 or something like that, and I can't see it. But this is what I wanted to show you guys. After it came back up, it popped out the Bollinger Band, dropped down, popped out of the Bollinger Band, dropped down, or that day it may have went up and then opened up high the next day, higher above the Bollinger Bands, and then back down. Now look at what it did. When it came back up and did not pop out of the Bollinger Bands another time. And now it's about to confront the 200-day SMA right there, which is a way more sturdy line than any of the other ones. This is the long-term trend line here, the long-term moving average, which is, to me, is a resistance line that is much heavier than these other ones. That's why you always see stuff colliding and dropping, or just barely getting over it, not closing above it, then dropping the next day, because it's such an important line. Well, now it's about to collide with that, in addition to, if it breaks above that tomorrow, it's going to be breaking above the 200 and at the same time popping out of the top of the Bollinger Band. So it's going to send a sell signal and a buy signal at the same time. There is already 54% of the shares short for this thing. I'm talking about the outstanding float. So, hey Siri, what is 0.54 times 30 million?
0.54 times 30 million, 16,200,000.
So you have about 16,200,000. Now that's assuming, I think, what do they have? They have 35 million shares, and then let's say 30 million are float, because let's say 5% is owned by insiders or somebody else. Let's even say if it's 32, they put about 17.2 million shares short, right? You got 54.86%. 17 million with an average volume over the last 10 days of 7.39. That means it would be covered. It would take 3 days to cover all the shares short. Less than 3, but it would take 3 because it's only 7.39. So 2 days would be like 14.5, 14.6 million. So you'd need the third day to cover all the outstanding shares. Now, there's no way all the shares are being covered every day, but what could have happened is a lot of covering, right? And then a lot of covering could have happened and then led to more shorting because people are like, now it's at 1689, I'm going to short it here, knowing they got this major resistance line at the 200-day SMA. Now think about that though. That means that the average, the percentage of shares short may not have changed much. It may still be around the 50 because of all the ones who covered, then all the ones who ended up shorting on top of that because they were like, now I'm shorting it. If that's the case, I know this is a two-way call and these are the worst because it's like I'm saying two things are going to happen, but I'm telling you this is what could happen. It's impossible to know because it's going to come down to how many people short and how many people cover, how many people buy, all that stuff that we already know about. But I'm telling you, this is a very, very important point right here. If you don't know that already, you should know this. When it breaks above that 200-day, if it breaks above it and pops out the Bollinger Bands, you may get like the same thing that happened here where it popped out, then the next day was a big rise. So you may see a pop through here where it actually tomorrow opens up above it and then it opens above the 200 and then also pops out of the Bollinger Bands. And then you'd initially think short it. So a lot of people may short it. Then what would happen is the next day, of course, people would force the covering by buying deeper into it. And then it would look like it's going to run. So it might go to up to like as much as 20, 21, 22, something like that, right? So you might get to there fairly fast, maybe like 20. But then what would happen from there is it would drop deeply. Or it can be that it never breaks this. And once it gets there tomorrow, it confronts the 200-day and then just drops deeply from there. Like maybe just barely pops out of the Bollinger Band, confronts the 200 right there. So right here, it'd be like the, you know, you'd be, because look, it's at 1689. So it may come like 1767 tomorrow. It just like gets above it. And that would also push it out of the Bollinger Bands. And then you see a drop reverting it back to the $14 range, $13.50 range. And I know that seems a bit crazy, but as you can see, when it does tend to revert, it reverts back to the 20-day SMA or the middle of the Bollinger Bands. Look right here. Matter of fact, let's go to the 3 months to take a deeper look because you want to see where the initial start happened. So look what happened. Initially, it was using those. Look right here. It was using those as their, it was using this as their drop point, right? The bottom of the Bollinger Bands and then going up to the middle range and then bottom. And then finally it did a turn for the better. And look what it did. It popped out and then came back down, popped out, then came back down, popped out. And look what it came back down to. The middle of the Bollinger Bands and the 20-day SMA are right next to each other. So those are your two lines of support. So if it does fail here, where's it going to go? Right back to there. It's going to go right back to there, which should be that range. Now, one last thing we'll take a look at here. We want to look at how did it get here? What was the... You want to take this right here, take a picture of this right here, and if you look right here, how did it get there? Well, this is a good example of something that we should all be looking for when we're doing our trend lines and stuff. If you actually go here and you pull this out, we can really do it rudimentary. We don't have to go so deep. We want the basic picture here. Whoops, excuse me. Pull that there. I mean, you know that they could be touching a little bit better there, but it's okay. So look right here, boom, and then let's pull that out a little bit. Let's grab this line, pull it here, and look what we're gonna get. Look what we got here, okay? We got at least 3 lines, 4 lines touching when we do it like this, okay? Look at that. That's a falling wedge. That is a falling wedge, okay? And if you don't think that's a falling wedge, look at that. It's touching right there. It's touching there. I mean, it's touching like 3 spots right here, which is what you want. Like you're touching that one. It's touching that one. Whoops, put it back. It's touching, put it back. It's touching like 2 of them right there. And then you come down, it's touching that one. Touching those 2, touching that one. I mean, that's like 5 lines touching. Consider that for a minute. That's like 5 lines touching right there. Okay? You have 5 lines touching there, and you have the same thing here. You have 3 right from the top, 1, 2, 3 down there, and then 4 right here. So if you consider that, look at that, and then look at the breakout upwards. It wasn't until it broke out over here. This is where the break happened. When it broke up like that, is it came out of the falling wedge. Look right here. We'll save that for 1 second. Matter of fact, we'll save it. Just go like this. Done. Save the photos. Let's go to falling wedge. Breakout from falling wedge. We'll go here. falling wedge breakout, falling wedge pattern. Go into images. It's the easiest one you can look right there. Boom. Look at that. Absolutely stunning resemblance, is it not? Matter of fact, we don't even want that one. I like this one better. It's bigger, and look at that. So you have the falling wedge pattern. Okay. You got the falling wedge right there. We want to take a look. This is almost, but there you go. It says buy right there, and look what would happen. Look right there. Take profit right there. See what it's saying? Buy there, take profit right there. Now let's go back and see where we're at with ours so far. Remember what this picture looks like. See it right there? Take a good look. It's saying take profit up there. Let's go back to see our picture, which is right here. You want to take a look. Okay, look. So right here, remember what I just told you. If it breaks out, it could break up to like the 20, 22 range, which actually I was serious about the 22, and this is why. Look at where it will break to. If it breaks out and breaks up and above the 22, forgive me, the 22, I keep messing up, right there, look where that puts you. Boom. And that's what I was telling you about, taking your profits there. So even though it doesn't seem like, really, dude, it's only at 17, it could really break it. Yes, it can, but it could get rejected there as well, right? And one thing you want to look at is when you're actually looking at that, you want to look at this real quick, see how it could get rejected right there and then come back down, and then it could go back up. But this is why. Look right here at the falling wedge that's in the example. See how it, look right there. It initially has its rise when it breaks out. It does break out right there. It has its breakout. This is like what Overstock's doing right now. And then it collapses because it runs into something major along the way. Then it breaks back up. Now this is the point I was trying to show you before. As it breaks back up there, look what happens here. So why would Overstock do that? Well, if you take a look at the chart, what happens is when it breaks back down, you have to consider the new trend line that has formed. Now it has formed this trend line right here. So now you have this trend line going on. So you add this. This would be like over the, 1 month time frame. We're on like the 6 month in that picture there. But if you actually take this one, let's make it blue so it's stands out a little bit more. Make it smaller. So look, this is your new trend line now. It's like straight up, right? It's like straight up. But look, it's actually here because you need to touch as many as possible. So it touches there, 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 there. That's touching like 3 lines. So you see what I mean? It will want to revert back down to here. And then if it does fall through there and falls through, you will need the ones I was showing you to come up and catch it. This is your middle line. That's your 20-day. Those will need to catch it. So you'll get a drop back down to, let's say, 1470, 1450. And then it will go for the next breakup, which would put it up to that 22 range. Remember, it would be up that range, which aligns with the actual initial starting point where it came from. Okay? I know it seems like I'm just drawing these things, but hopefully you can go back and actually take a look at what I was doing this whole time and drawing it out for you. And then if you consider what I actually showed you compared to what a normal falling wedge pattern will look like, you'll see that there's a lot of resemblance there. And that's why it would be good to consider taking the profits around that range up here. And then if there's if let's say it does blow, okay, that sucks. But if you sell here and then it reverts back down, then you get back in around the 16, around the 1480 range, 1450 range, then it may make the push up to 22, which would be right up here. Now it could potentially do it very soon with all the short covering. So I know it seems like a lot, but basically what I'm telling you is that we'll go to 22 or we'll go to 14, back to 14. So you're literally looking at a big push up or a big push down, 3 up, 4 up, or 3, 4 down. And that's the way it's going to have to move at this point because there's so much drama in the area it's in right now that there's going to be so much pressure. So I hope that's helpful to somebody. Thank you for showing up. I hope you guys enjoyed it. I hope you guys learned something. Let me know in the comments, please, and tell me what you think. Tell me if there's something you're watching. Tell me if there's something you love. Tell me what your trick is, and I would love to learn. I love to learn too. I don't know everything, so I love to read and figure out things that other people are doing. Show me how you're being successful and what might help me be even more successful, all right? Thanks, guys. Peace.